On September 29th, 2025, something strange happened in the agricultural markets. They just went quiet. On the surface, it looked totally calm, but let me tell you, underneath all that, the pressure was building to an absolute breaking point.
So what does a calm market even feel like? Well, for traders, it was a day of super narrow ranges and kind of mixed results. But analysts said the feeling was just unfulfilling, you know? It was pretty clear this was a market holding its breath, just waiting for a major shock to the system.
So what was really going on behind the scenes? Look, it wasn't just one thing. It was like a perfect storm of factors all converging at the exact same time. So let's peel back the layers on the three key forces that were building all this pressure.
Okay, first up, the first major force at play was the massive American harvest. It was just starting to pick up speed, and this is your classic, textbook supply pressure.
At this point, the U.S. corn harvest was expected to be about 20% complete, and the soybean harvest was right there with it at 19%. And believe me, this was just the beginning.
And the context here is everything. The weather was just gorgeous for harvesting, which meant farmers were going full throttle. This is what we call harvest pressure. A flood of new supply hits the market, and that naturally pushes prices down. But that pressure, all by itself, doesn't explain this strange pause.
All right, now for the biggest drama of the day, and it all centers on one critical crop: soybeans. Seriously, this story has it all. We're talking geopolitics, media hype, and a massive trade standoff.
The answer really comes down to this geopolitical standoff, that it whipped the mainstream media into a total frenzy. This wasn't just a niche story for ag insiders anymore. This was front-page news.
And here's the absolute core of the problem. Even though U.S. beans are about 10% cheaper on the global market, a 23% tariff from China just makes them completely uncompetitive. And the result? China, who's historically been the biggest buyer, hadn't bought a single new crop U.S. soybean.
This media frenzy created this overwhelmingly negative story. It seemed like the consensus from everyone was that you should be betting against, or shorting, soybeans.
But here's the twist. Some traders saw all this negativity as a contrarian signal. You know, when a trade seems way too obvious, it often isn't. And this just added another layer of tension to the market. You had to wonder, were the bears walking right into a trap?
So if you've got harvest pressure pushing prices down and this whole soybean saga full of drama, why the quiet? Well, that brings us to the most crucial point, the single biggest reason for the market's total paralysis.
I mean, everyone, from farmers to massive hedge funds, was just frozen, waiting for a huge data release from the U.S. Department of Agriculture. Absolutely no one wanted to make a big move before these numbers dropped.
The report everyone was waiting for was the quarterly grain stocks report. Now, this isn't about the new crop that's coming in. It's all about how much of last year's crop is still left in the bin. And this report in particular is notorious for delivering some absolutely massive surprises.
And this really highlights the central tension. On the one hand, for corn, there was a real fear the USDA would find a few more bushels, confirming a bigger supply than expected. But on the flip side, soybean stocks were thought to be incredibly tight. So this report could have sent these two markets flying in completely opposite directions. And it wasn't just the stocks report. Traders were also watching wheat data and the very real political risk of a government shutdown. A shutdown could delay the next round of critical reports, basically leaving the market to fly blind. Talk about uncertainty. So finally, while the grain markets were basically paused, the livestock sector was telling a completely different and way more decisive story. There was zero hesitation here. Money was flowing and flowing decisively, but in two very different directions. It was a classic bull versus bear scenario playing out in real time.
On one side, you had hogs. After a positive government supply report, big investment funds pushed their bullish bets to a record-long position. That's a huge signal of confidence that prices were headed higher.
But on the other side, you had cattle. With weak-looking charts and negative price action, the funds were actively walking away from their long positions. This selling pressure was a clear vote of no confidence.
So, to wrap it all up, this single, quiet day was absolutely packed with pressure from the harvest, high drama from the soybean trade war, and this intense anticipation for a game-changing government report. The calm is officially over. The stage is set for a massive, volatile reaction. The only question is, when the storm hits, which way will the market break?